What's going on, guys? My name is Ricarda Mills, and known on my socials as Riv Carda or Ricarda Mills. And if you're watching this video, you've fallen into one of two camps. One, you've either been following me on social media for quite a bit some time, and you're eager to find out what it is exactly that I do, how I build my wealth, and also how I get compensated for educating on financial literacy. Or two, you've recently met someone, or maybe you've known them for a while. You're also eager to find out what it is that they will be doing, how they've been able to generate a part-time or full-time income educating on financial literacy. So let's go ahead and get into it. The reason I decided to choose this industry to be the kickoff to building my wealth is because I didn't know anything about how money worked. I learned from a super young age that you need to know how your money works before it ends up working you. My parents did the best they could by me, but I was still limited on what they were exposed to. While I was working job after job, still living paycheck to paycheck, something had to change. The reason I decided to be introduced to PHP and come on board is because it's simply people helping people. We're actually partnered with Integrity Marketing Group, which is one of our nation's largest privately held distributors for health, wealth, and insurance products. So we're also going to be called an FMO. That's one of the key components of building this business, and you'll find out why. An FMO stands for Financial Marketing Organization. That means we market financial products on behalf of Fortune 1000 companies like National Life Group, been around for over 175 years and paid out people on the Titanic. You also have American National, Forsters, a nonprofit whose sole mission is to put more money out into their policyholders' pockets with competitive scholarships, grants for nonprofits, and many more. But all of these companies that you see popping up right now are actually having a big problem. They've been around for centuries, billion-dollar companies, the backbone of America, but they're shrinking. Not in a matter of them losing money. They actually just have their average agent as a 61-year-old Caucasian male. Of course, there's nothing wrong with being 61, nothing wrong with being Caucasian, of course. They just have one foot in, one foot out there about to retire. And they have a hard time connecting with other demographics. Only thing is, these companies, they don't care what you look like, where you come from, or even how old you are. They just care about the distribution of their financial services. One of the key concepts that we weren't exposed to sooner in life are the 3 ways that money grows. No matter what background or career you have, you need to know all 3 different ways your money can work when we're typically only exposed to the first 2. These will be fixed, variable, and index. And we can agree there are pros and cons to everything in life. Fixed being your bank accounts, saving accounts, maybe the shoebox you keep under your bed, money in the freezer, however you save your money. Upside to having your money in the banks is that it's backed up to $250,000 by the FDIC. It's safe. You never have to worry about losing anything there. Only downside is you're getting little to no growth here. So long term, this is what it would look like. Very stagnant, probably not the best place to put your money if you want to see it grow. That's why people typically invest into variable accounts. These will be your employee-sponsored accounts like a 401k or a TSP if you work with the government. You also have Forex, stocks, crypto, real estate. Upside to those types of accounts is you can experience exponential amounts of growth. But what goes up must also come down. You can lose all or a portion of your money in these accounts, and how much can we truly afford to keep losing? If we took a trip down memory lane, back in 1999, you had the dot-com bubble burst. In 2001, the Twin Towers collapsed. And then in 2008, the housing market crashed. 2020 pandemic. So it's not the matter of if or how the market will crash, just when, and how are we protecting our assets from it. Now, this last one is actually the least talked about account. You can access it through an FIA, a fixed indexed annuity, or an index universal life, an IUL. Upside to these accounts is that your money is safe. You have a contractual agreement with those companies I mentioned in the beginning saying you cannot lose any money in these accounts because it's insurance. And insurance products have a disposition to never lose its value. Only downside, since you're going to be capped on growth in most cases, anywhere from 0 to 9%. 0% being your floor, you cannot go below it. 9% being your ceiling, you can't go above it. When we say index, that means our money is indexing something. We're going to reference the S&P 500. That stands for Standards & Poor's, the top Fortune 500 companies in the world. You have Amazon, Nike, Tesla, Walmart, Walt Disney, all warped into one giant stock market index. Except your money's not going to be put into that stock market index to go through the ups and downs of the market. It's just going to mirror the growth of it. So let's say that the S&P decided to do 20% one year. In this index account, you would have gotten the full 9%. And then let's say the S&P did 8%. In this index account, you got the full 8%. The market crashed like it did in '08, negative 38%. How much do you think you lost in this account? If you said 0, you are correct. In this case, 0 is your hero. You didn't gain, but you did not lose, most importantly. If you're a visual learner like me, this is what it would look like long term. When you're up, you're up. When you're down, you're flat. You lock in your gains, you pick right back up where you left off, kind of like an escalator. So if you were to decide between these 3 types of accounts, which one you want to put majority of your money into, what would you say? And if you chose the index, most of my clients do say that. But here with People Helping People, we actually believe in all 3. You don't want to have your eggs all in one basket. So if we go through the ups and downs one more time, let's see what makes the most sense for the type of money we have in those accounts. And the fixed accounts, like your banks, we love the safety, but if you like to make money, this isn't going to be the best place to keep all of your money. We recommend about 3 to 6 months worth of expenses being in these accounts, taken care of for any emergencies or unexpected expenses. Now, your variable accounts, we love the growth on the money, but you probably don't like to lose money. This is the money you want to put there that you're not willing to lose. Now, the index accounts, we love the safety and we have growth, giving us best of both worlds. But there's this guy named Warren Buffett. At this time of the video, 5th wealthiest man in the entire world, deca billionaire. Actually has 2 rules to money. Rule number 1 is don't lose money. Rule number 2 is to never forget about rule number 1. So he's not saying don't make money. He's just saying don't lose it, talking about a concept called principal protection. Let's say I were to give you $100. You decide to put that into the stock market. Market dropped negative 50%. How much do you have left? $50. Now, if the market goes up another 50%, how much do you think you have now? If you said 75, you're correct. If you said 100, I did my first time as well. But Warren Buffett's saying here, you're going to have to work twice as hard just to get your money back, and then try to get profit on top of that. So imagine you were a baby boomer putting a portion of your paycheck into your 401k every 2 weeks. From 1999 to 2008, you just went through 10 years of a recession. Retirement accounts, probably not looking so well. So here we educate on how you can refrain from that, put insurance on your 401ks, and protect the money that you are not willing to lose while also getting substantial growth in it. So now you know the 3 ways that money grows. This is what we call a financial foundation. Realistically, we all know in life, there are 95%ers of the world and there are 5%ers of the world. We have access to the same information, education, YouTube University, whatever you want to call it. We just don't really know the proper way to create that foundation of wealth for ourselves. So a lot of us typically go into the stock markets first. We say that's where we know for a fact we can create the most income or long-term revenue. So you go into 401ks, Acorn accounts, you also have TSPs. Then we talk about getting into our home, whether you're going into real estate, trying to buy your first home. Then you start worrying about savings, emergency funds, making sure that I don't have to worry about anything for a rainy day. Then once we're getting closer to the time of our demise, which is inevitable, we start thinking about life insurance. How can I create that generational wealth for my family to get passed down? It's a great philosophy, but it's backwards. Life insurance is actually supposed to be the foundation of it all. You're not going to build a house on sand. If you build it on rock, understanding that life is going to happen, we're going to accrue assets and debts throughout our lifetime. We have life insurance as the protection of it all. And then you go into your savings, building an emergency fund, 3 to 6 months. Now you're talking about buying your first home once all of the safety nets are taken care of. Now you start investing into the stock market because remember, that's money you're not willing to lose, but you know you can get a great penny for putting your money there. So here we educate people on how you can flip the script, and it's better late than never. If you're starting off in a smaller place, then even better. You want to have that foundation properly taken care of so we can decrease that wealth gap we have here in America. Now, never in a million years would I have told you I would become a life insurance agent. I probably would have walked away and laughed because we're typically only exposed to what life insurance is, not what it actually does. But if you can agree with me, from the tops of our governments down to our kitchen tables, there are issues and obstacles arising around money for the average American today. Let's put on an imaginary lens. Say that you're someone open to making additional streams of income in the financial services industry. What does that look like? Now, here we actually get paid in 23 different ways, but for the sake of time, I'll keep it to 3. First one being term insurance. Term is short for terminates. It's a temporary policy that typically lasts about 10 to 30 years. This is the type of policy we have as new homeowners, or if you recently just started a family. This client, for example, wanted to get $500,000 in the death benefit. They're saying, look, Ricarda, I don't want to deal with the GoFundMe or have a potluck for unexpected expenses. I'm going to go ahead and be responsible, get some insurance. Now, this client decides to put away $50 a month. These aren't one-size-fits-all types of products. So National Life Group, they're saying, thank you so much, Ricarda, for introducing us to Michael, because if it weren't for you, we would have probably never met Michael. So we're going to advance Ricarda 12 months times the average contract in our firm. That will pay Ricarda $300 in under 2 hours of work. What's in it for our client? One, they're going to get super cheap insurance, and it's better to be too young than to be too old and uninsurable. Only thing is, this is great for some, not for all. If you're in the market for life insurance, you would probably want to have it for your entire life. So this will be the UL for Universal Life or IUL for Index Universal Life. Our client is still looking to get $500,000 in a death benefit, but looking to get the best bang for their buck. In this example, our client decided to put away $250 a month into a policy like this. Now, a company like American National is saying, thank you so much, Ricarda, for the introduction. We have a hard time reaching diverse markets, so we're going to advance you a full year. That will pay Ricarda $1,500 in under 2 hours of work. How many jobs do you know are paying $1,500 an hour legally? Now, the money is great. What is something that we all truly value in life that we can never get back? Our time. If you're familiar with the concept called passive or residual income, we'll get paid 4% on whatever our clients paid for the entire year. In this case, that's about $120. Now, I told you all I got introduced to this industry at 19 years old. No financial experience, no life insurance experience. I had to learn. As I started to learn more, I didn't only help one family a year. I helped a couple families a day, a week, a month. It all started to add up. Now I was creating something called a book of business that continues to pay me out for the duration of these policies. Now, this is great for us, but this is people helping people. What's in it for our client? For one, you're going to get permanent insurance. You're not putting an expiration date on my life. Second, you're having cash value, anywhere from 0 to 9%. So you have cash growing for you in this account. You can take out and put towards whatever you deem necessary, whether it's a car, a house, a vacation, business venture, real estate property. If you didn't know, Walt Disney was funded by cash value life insurance, as well as the Pampered Chef, Johnson & Johnson, JCPenney, McDonald's. The third thing is you have tax-free access because of the IRS tax code 7702. My folks who say, I'd rather not get taxed now, taxed later, I want to get taxed never. You have that opportunity within an Index Universal Life policy. And then the last thing is what we call living benefits. Life is inevitable. If you know someone who has gotten diagnosed with cancer, had a heart attack, stroke, got into a car accident, life completely changed forever, raise your hand. No matter how much we don't want to talk about it, it's necessary. You can access up to 90% of your death benefit while you're still alive because of living benefits, even long-term care and disability. Let's say you or someone that you know actually have been working at their job 30, 40, 50 plus years maybe. You've been putting a portion of your check into a 401k or a Roth IRA. You decide that you're tired of putting your money at risk in the market. The number one concern for retirees today is outliving their money. So some of our clients who want to have their money outlive them decide to protect it with an annuity. As agents, we get paid 8% on what our clients put in of their hard-earned lump sum of money. Now, that'll pay us as agents $4,000 for the same amount of work to put into this policy. That'll give our client uncapped growth potential. You'll be following and mirroring markets like Barclays or BlackRock. We also have principal protection. God forbid anything were to happen within the market, your principal will be protected. So you never have to worry about losing money in this account. Third is you have a tax-free rollover. We already been working hard. We don't want to deal with any extra penalties. Then lastly, you have a guaranteed lifetime income that has the potential to pay you out every single month for the duration of your life to where your money can now outlive you. Call it a self-generated pension. Those of you who are saying, I could actually see myself doing this. We are a highly regulated industry, so if you happen to have any felonies or misdemeanors dealing with money, it will be quite difficult for you to get licensed with us. We do background checks. We're dealing with people's private information. So you are required to get your license in your state. Now, it's only a couple $100, not anything that's going to break your arm or a leg, but it is going to be a requirement for you to sit down and get compensated in this industry. And for you to come on board with us as an agent, there is an agency platform fee of $199 that is a tax write-off as you're starting your own business. You're getting access to the carriers, to the software, the licensing support that's self-appointed to you to actually help you A through Z on how to get licensed and pass efficiently. Then you also have trainings at our office on Zoom, and we make it super easy for part-timers to learn a new industry, typically allowing only 5 to 10 hours to truly get your business off to a good start. Now, with us being in the insurance industry, our job is to work off of guarantees. So these are 3 guarantees that I can give you if you were to come on board with us today. First guarantee is you're going to learn about how money works. You'll learn about 401ks, tax rates, some of the matriarch of finances in your family. That is going to be a good thing for your family's financial future. Secondly, you're going to introduce your loved ones, the people that you come across every single day, to a national life group or Fidelity and Guarantee. Now they can have the security and knowing that they will be able to pass down $250,000, $500,000, even $1 million to their loved ones that they can also leverage while they're still alive. Now, if that sounds like a great thing for you and your family's financial future, reach out to the person who introduced you to this video. And lastly, we're going to challenge you here. We understand that in order to increase your income and retain it, you have to increase your identity first. And the way you increase your identity is by the books you read, the meetings you attend, and the people you surround yourself with. So if all 3 of these guarantees sound like a great thing for you and your family's financial future, I don't see any reason for you to not get started unless you do.